Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, April 24th, 2026, and we're closing out the week with some notable developments across technology, energy, and corporate earnings that are shaping market sentiment. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The standout story this morning is the semiconductor sector continuing its remarkable run. TSMC shares hit record highs after Taiwan eased single stock investment caps for funds, which is significant because it opens the door for more institutional money to flow into these chip stocks. But here's what's interesting. We're also seeing warnings from analysts that this semiconductor rally is unprecedented, and there are real concerns about whether Wall Street is repeating the mistakes from the COVID era when tech valuations got completely disconnected from fundamentals. On the energy front, we've got Stanchart calling for a new oil equilibrium at $95 per barrel, which is a substantial shift in their outlook. Meanwhile, Europe is dealing with jet fuel supply problems that are directly impacting airlines, and there are market abuse accusations flying around involving BP and Repsol in Spain. The corporate earnings picture is mixed, but leaning positive. Procter & Gamble beat estimates with 7% sales growth, showing consumer staples are holding up well despite broader economic concerns. On the flip side, Nike just announced its second round of layoffs this year, cutting 1,400 roles, which tells us that even major brands are feeling pressure to restructure and manage costs more aggressively.
That semiconductor warning is particularly interesting, given how strong the momentum has been. What does this mean for traders positioning in tech right now?
It's a critical inflection point, Robert. The momentum is undeniably strong, institutions are piling in, and the fundamentals around AI demand remain solid. But when you start hearing phrases like unprecedented rally in comparisons to COVID-era mistakes, that's your signal to be more selective and disciplined. I'm not saying exit tech positions entirely, but this is where you need to separate the leaders from the laggards. Companies like TSMC that have actual earnings power and supply chain dominance versus speculative plays that are riding the wave without substance. The Taiwan regulatory change is genuinely bullish for TSMC specifically because it removes a structural barrier to institutional ownership. For traders, I'd be watching the semiconductor index closely. If we see a break below key support levels with volume, that could signal the start of profit taking. On the energy side, that $95 all-a call is important for sector rotation. If oil stabilizes at higher levels, energy stocks become more attractive on a relative value basis compared to stretched tech valuations. The jet fuel supply issues in Europe create a more complex picture for airlines. You've got cost pressures at a time when travel demand is still recovering. I'd be cautious on European airline stocks until we see how this supply situation resolves.
Let's talk about the broader indices. How are you reading the technical picture across the major markets?
Looking at the S&P 100, we're seeing consolidation near recent highs, which is actually healthy after the run we've had. The index is holding above the 50-day moving average, and as long as we maintain that support, the bias remains bullish. Key resistance is about 2% higher from current levels, and a break above that on solid volume would signal continuation. The risk is if we get a sharp tech sell-off that drags the index below that 50-day support, then we're looking at a potential test of the 200-day. For the Nasdaq, the situation is more nuanced because of the heavy tech weighting. We're at a point where the index is extended on most momentum indicators, RSI is in overbought territory, and we're seeing some bearish divergence where price is making new highs, but momentum isn't confirming. That doesn't mean an immediate reversal, but it does mean the risk-reward is less favourable for new long positions. I'd want to see a healthy pullback to the 20-day moving average before getting aggressive on the long side. The Dow is actually showing relative strength, which is interesting because it's more weighted toward industrials and financials. It's holding in a tight range and building a base, which historically has been a good setup for a breakout. The blue-chip nature of the Dow components provides some defensive characteristics if we do see rotation out of high-growth tech.
That selectivity is going to be key, Steve. Let's get into the economic numbers. What's the picture looking like from the data perspective?
Thanks, Robert. We're in an interesting spot on the economic calendar right now. This week, we had some important housing data come through that showed existing home sales declining more than expected, which is raising questions about the strength of the consumer at these elevated interest rate levels. The mortgage rate environment continues to be a headwind for housing activity, and that's something the Fed is certainly watching. We also got initial jobless claims yesterday that came in slightly higher than the previous week. Now, that's not a major concern yet because we're still at historically low levels, but the direction of change matters. When you start seeing consecutive weeks of rising claims, that's often an early signal that labor market conditions are softening. Looking ahead to next week, we've got some significant releases that could move markets. The big one is the advance estimate of first quarter GDP on Wednesday, and the consensus is expecting growth around 2%, which would represent a slowdown from the fourth quarter. That report also includes the PCE price index, which is the Fed's preferred inflation measure. So we'll be getting a comprehensive look at both growth and inflation dynamics. On Thursday, we get the employment cost index for the first quarter, and this is critical because wage pressures have been a key concern for the Fed. If we see wages accelerating, that makes it harder for the Fed to consider any rate cuts this year. Friday brings us the core PCE price index for March, and this is really the Fed's North Star for inflation. They've been clear that they want to see sustained progress toward their 2% target, and recent months have shown inflation being a bit stickier than they'd like.
Those are some heavy-hitting data points coming next week. How should traders be thinking about positioning ahead of GDP and PCE?
The key thing is understanding that markets are currently priced for a relatively benign scenario where growth stays positive but not too hot, and inflation continues to gradually decline. If GDP comes in significantly stronger than 2%, that could actually be negative for equities because it reduces the urgency for Fed rate cuts and keeps monetary policy restrictive for longer. On the flip side, if GDP disappoints and comes in below 1.5%, you might see an initial negative reaction on growth concerns, but then a rally on the idea that the Fed would have more flexibility to ease. The PCE data is even more important in some ways because it directly influences Fed policy decisions. If core PCE comes in above expectations, that's going to push out rate cut expectations and likely strengthen the dollar while pressuring equity valuations. We're also getting personal income and spending data next Friday, which gives us insight into consumer health. The consumer has been remarkably resilient, but we're seeing some cracks with the credit card delinquency rates ticking up and savings rates declining if spending growth slows meaningfully. That has implications for corporate earnings expectations in the coming quarters. The other thing I'm watching closely is the regional Fed surveys. We had some mixed signals recently with manufacturing activity showing weakness in some regions while services remain relatively strong. That divergence tells us the economy is not uniform and different sectors are experiencing very different conditions.
Lizzie, let's shift to crypto. What are you seeing in digital asset markets as we head into next week?
Bitcoin is in a really interesting spot right now, Robert. We're seeing strong institutional momentum with $2 billion in ETF inflows over just 8 days, and the price is targeting a monthly close around $77,500, which would mark the best gains since the fourth quarter of 2024. The sentiment is cautiously bullish, and I'd characterize the market as being in what analysts are calling a disbelief phase, where fundamentals are strong but there's still skepticism. The critical level everyone is watching is $80,000. We need a daily close above that level to confirm the next leg up. Support is solid around $77,000 to $77,500, and if we hold there into next week, the setup looks favorable for a push higher. The institutional adoption story continues with companies like Metaplanet raising $50 million in zero-interest bonds specifically to buy more Bitcoin, which shows corporate appetite remains strong. On the risk side, we're seeing short-term holders quietly selling despite the ETF inflows, and there's an extreme inverse correlation with the dollar right now, the most extreme in almost 4 years. So if the dollar strengthens on next week's economic data, that could create headwinds for Bitcoin. Ethereum is showing moderate bullish characteristics, with ETF inflows hitting a 10-day consecutive streak, which is significant. Price is consolidating at $2,300, and the technical setup suggests we could test $3,000 resistance in the coming week. 3 key on-chain metrics are pointing toward a potential rally to $6,000 longer term, but next week I'm focused on that $3,000 level as the near-term target.
What about institutional versus retail positioning in Bitcoin right now?
That's where things get really interesting. The institutional side is clearly in accumulation mode. Those ETF flows are predominantly institutional money, and we're seeing corporate treasuries continuing to add Bitcoin to their balance sheets. The Metaplanet bond raise is a perfect example. They're using zero-interest debt to acquire Bitcoin, which is a sophisticated corporate finance strategy that shows conviction. We're also seeing developments like the US military running a Bitcoin node, which might sound niche, but it signals that even government entities are recognizing Bitcoin's strategic importance. On the retail side, the picture is more mixed. Retail participation has been growing, but we're also seeing short-term holders taking profits at these levels. USDC exchange reserves are pushing above $7.5 billion, which typically indicates retail money is moving to exchanges, potentially to buy or trade. The sentiment among retail is less uniform than institutions. You've got the true believers who are buying regardless of price, but you also have a lot of traders who are more tactical and willing to take profits after a strong run. Looking at Solana, the sentiment is bullish, with institutional staking products being added by firms like Anchorage Digital. Price is forming a bullish channel pattern, and the key resistance is at $90. If we break above that level with volume, Solana could have significant upside as part of a broader altcoin rally. The interesting dynamic is that altcoins generally need Bitcoin to perform well first. Analysts are saying altcoins could have 30 to 60% upside if Bitcoin reaches 86,000. So there's a clear hierarchy in how this market moves. For next week specifically, I'm watching Bitcoin's ability to hold 77,000 support and make a run at 80,000, Ethereum's consolidation at 2,300 and potential move toward $3,000, and Solana's test of that $90 resistance level.
Well, that gives us plenty to watch as we head into next week with those major economic releases and key technical levels in both traditional and crypto markets. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell and join us Monday as we break down the GDP and inflation data. I'm Robert. Thanks for listening.